All right. What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. And so, going a little bit over kind of the problems of community banking, I wasn't aware of basically, I don't know, I haven't really noticed it. I haven't been seeing as many. Maybe that's just because since I read this, I'm kind of thinking about that more of like how little kind of community banks I've been seeing. Again, that's just anecdotal. So, it is what it is. But regardless, kind of getting into some actual statistics, which I think is pretty interesting. And this all comes from a recent speech given by Governor Michelle Bowman. This was just a few days ago at the the Community Banking Research Conference, which is a thing. And there's a lot of things that I was unaware of. And so as you can see, we'll head over to the screen share. Right. So to get right into it, back in 2013, in the wake of the financial crisis and the passage of the Dodd-Frank Act, the Federal Reserve, the FDIC, and the Conference of State Bank Supervisors, the CSBS, created this conference, the Community Banking Research Conference, based on the understanding that research plays a vital role in the shaping of the nation's supervisory and regulatory policy. uh, Pretty typical stuff. I just wanted to put that in there, mostly to see who, so you guys can see who the three kind of entities are that were a part of this. And so basically, the CSBS National Survey of Community Banks was eventually created from this conference, right? The survey gathered data and insights that were previously unavailable on this scale directly from community bankers, because these are typically your smaller banks, not your kind of national in scope. So, among its many contributions, the survey provides data on the costs of regulatory compliance and the trend data on products and services being offered and, in some cases, discontinued by community banks. A lot of the times, I really wanted to point out the costs of regulatory compliance because this is something that we've talked about a few times and just kind of sprinkled throughout the previous videos when we're talking about increasing regulations and that sort of thing, is how expensive it is for banks to remain compliant. And that's not even just banks, like that's applicable. I think it's a very generalized principle from what I can tell. Right. So talking about like companies and different industries and that sort of thing, the more you increase regulations, the kind of more difficult it is for the smaller entities in that industry to really compete or to pay for such to pay to comply, right? Because you have to either have more boards, more kind of committees, or whatever you want to call them within these entities to really remain compliant, to put together the kind of what they have to publish or give to the regulators, right? To kind of aggregate this data, whatever they're asking for. And so you really have to pay attention to that. So, one of the more interesting findings from the CSBS survey has been that how community banks have reported changes in competition for both deposits and loans. So, although the majority of community banks report that other community banks are still their primary competitors, the majority have steadily declined in each year of the survey as credit unions and larger banks have become the dominant competitors for deposits in an increasing number of markets. And so each year, a larger percentage of community banks report fintech firms as their primary competitors for consumer loans, the farm credit system as their primary competitor for agricultural loans, and non-banks as their primary competitor for mortgage loans, right? And so it's almost like you're having more smaller, I don't know if I'd say smaller, but more specialized entities come in and basically sweep out community banks. And so as we'll kind of get into in a minute, they're talking about basically changing the Bank Merger Act, or kind of the regulations around bank mergers, right? Maybe to help kind of these smaller community banks who can't really compete with those specialized entities for whatever reason, and some other problems with, say, like the markets and stuff that they're in. And so, especially with how they kind of gauge whether or not they'll allow a specific bank merger to happen, is based on like where they are in the country, their exact kind of, I guess, profile of products and services that they provide, right? And so really kind of preventing monopolies in a way. And they have a measure for this and everything, which we'll get into in a second. And actually a tool that's available to the public that I didn't know about. Pretty interesting. But regardless, so in just 10 years, the number of bank charters has declined by approximately 20%. So I'm not surprised that it's declined, but I didn't think it'd be close to 20% in just a decade, right? And so at the end of 2012, there were about 5,900 commercial banks in the United States. The current number of charters today stands at just below 4,800, right? So this decline in charters has been concentrated among banks with less than 250 million in total assets, right? So the smaller banks relatively, because and we're going to go with the significantly smaller banks because we could talk later about banks with more than a trillion in assets. And so it's kind of like that's orders of magnitude difference in total assets. And so that's quite a big deal, at least I think. But up until 2009, the number of bank branches increased despite the decline in the number of bank charters. However, since the 2009 financial crisis, the number of banks have declined each year, the number of branches have declined each year. This decline was particularly pronounced during the pandemic when between 2020 and 2021, the number of bank branches declined by almost 4% as more than 3,200 branches were closed, right? So that makes me think, if the individual branches within a specific bank are decreasing, right? So it's not necessarily the amount of banks in general, but the amount of branches within a specific bank too are decreasing. Then maybe the banks. That leads me to believe that the banks are kind of struggling in a way, or at least these smaller banks, um, and so they're not able to maintain the amount of branches and that sort of thing to really kind of provide those services. There's not enough of an incentive, or they're not profitable enough, or whatever it may be. There's some form of kind of headwind, I guess, that's kind of preventing them from keeping these branches open to where they just can't operate with that many entities, right? And so they measure competition today largely. Oh, the way these bank mergers and stuff is kind of measured largely springs from a 1963 Supreme Court decision where the court held that the relevant product market for the purposes of analyzing a bank merger is the cluster of products and services that constitute commercial banking in each banking market. So they kind of have two key inputs that they use to evaluate this, which include the geographical definition of the banking market, which is a responsibility of the Federal Reserve, right? And they kind of define these markets. And so we see this kind of on a regional basis in the Federal Reserve System itself, where there's kind of the 12 different regions, right? Um, Obviously, there's more than that for the banking markets. Like as they say here, there's more than 1,400 banking markets nationwide on how they're kind of defining these. And then second is basically there's and a problem with it mostly. Is they have to understand the different products and services that are provided to these individual markets, right? And so apparently, historically, as she says, um, they've used the bank's share of deposits in a market as a proxy for market power for the broader cluster of commercial banking products and services. So the idea is that both consumers and small businesses often access commercial banking products through their deposit relationship institution, right? And so since it's difficult for them to go to each individual bank, period, throughout all the the 1,400 or so markets or so, and then the thousands of banks spread across those, um, it's basically they can't really tell specific kind of clusters. As she says specifically here, there's currently no way to comprehensively measure the full cluster of commercial banking products and services in a given market. And so that being said, they use the share of deposits of a specific bank within a market as kind of a proxy for this, right? To see how much they kind of dominate that market. Because I understand the reason for this as I kind of think about my own relationship with like my bank and stuff. It's like when you already have a deposit relationship with a bank, it's kind of easier. It seems easier for most people, kind of your average Joe and Jane, who aren't necessarily, say, like investors or entrepreneurs or whatever, who aren't going to basically, they just want convenience in that respect, right? And they're not going to go and look through hundreds of different banks or even dozens, right? Most of the time. We're talking about kind of like average people. And so basically, they're just going to go to the bank for a loan that they already have their depository institution, or they already have their deposits with, right? It's pretty much the low hanging fruit for the individual, right? So with that being said, I kind of understand why they do that way specifically. So in 1995, to speed the competitive review process and and reduce regulatory burden on the banking industry, the of Justice and the federal banking agencies developed several initial screens to identify mergers that would not have adverse effects on competition and would therefore not require significant review. These screens were part of a broader set of competitive review guidelines that also presented additional information that could be considered in the analysis of a merger transaction, right? And this kind of segues into the tool I brought up earlier, which we'll get into specifically. It's called Cassidy, I think. It stands for the Competitive Analysis and Structure Source Instrument for Depository Institutions, where basically you can check this kind of stuff yourself, right? But with that being said, we'll actually head over to the tool in a minute when we get to it in the actual speech near the end. Um, so you guys can see that and just kind of see what it looks like, right? And so basically how they kind of measure this sort of thing and these screens that we're talking about. So the initial screens are based on deposit market share, using the Herfindahl-Hirschman Index, or HHI. So excuse pronunciation. Under the scale, a perfect monopoly would report an HHI of 10,000, while a perfectly competitive market would be close to zero, right? So it's kind of measuring the monopoly power of a specific kind of entity, I guess you could say. And so under these screens, any merger that does not result in an HHI exceeding 1800 post merger or increases the market HHI by less than 200 would likely not require further review, right? And so just because they're over this 1800 mark or this increasing by less than 200, right? And so if they increase this index for their specific market by more than 200 or 200 or more, they would most likely have to have further review, right? And so I'm assuming this is why, like, if you check the Federal Reserve's website itself, talking about the actual Board of Governors website, you can see a lot of press releases for bank mergers and how they're kind of looking at those, right? And so for an actual statistic, more than 60% of the currently defined geographic banking markets in the United States are above this threshold, this 1800 threshold, on that index, right? And so it's kind of showing it's like you got less than 40% to where there of the actual banking markets. So given that there's more than 1,400 banking markets, according to earlier in the speech. And so basically, we're just going to kind of roughly round it to say 550 of the banking markets would not need further review for such a merger. And I'm assuming this is mostly with the smaller banks. Obviously, it's kind of what the purpose of the speech is, it seems. Um, so just kind of putting it in perspective. So, as any quick scan of the marketplace for financial products and services will tell you, in recent decades, the number of competitors to banks, if anything, has significantly increased rather than decreased. And this is part of the reason why they're wanting to kind of change how they're measuring this kind of merger on how they kind of evaluate the bank mergers, right? It seems. And so basically, it's like, you have these specialized entities like the mortgage lenders or that farm credit bureau that I already forgot the name of, that basically it's like you're having non-bank competitors come in, and that's they're really trying to. You can't just look at banks anymore. We get into just in a second, actually, the next highlights, the different kind of competitors that we're talking about. So for the first one, we have credit unions, right? So historically, credit unions were not seen as competitors to banks because they offer fewer small business and commercial lending products, and were limited in their customer base based because of the field of membership restrictions, right? So for this reason, credit union deposits were not factored into the initial competitive screens at all under the 1995 bank merger guidelines, right? And so credit unions weren't even really factored in this at all. But now they're actually, not only are these is the field of membership broadening to where sometimes they'll even take entire geographical areas. um, they're also expanding their products as well. So they're kind of becoming more and more. It's being harder and harder to distinguish from a consumer point of view, kind of how you're affected on whether or not you bank with an actual bank or with a credit union, right? Because they're starting to offer very similar products, and the actual functionality doesn't seem much different, I guess I should say. Basically, it seems like you're insured through the NCUA, the National Credit Union Administration, or the FDIC, and there's not much of a difference. And if I remember correctly, they both have the same $250,000 limit for their in terms of insurance on your deposits, right? And so the NCUA has reported that 94% of credit unions with 500 million or more in assets offer business loans. So the total business loans at federally insured credit unions grew at an annualized rate of 14% through 2004 to 2015, right? And so they're really, and especially in the small business kind of arena, credit unions are becoming more and more of a competitor um, in these types of markets. Second one is online deposit gathering. So I'm not 100% sure on where the nuances are with this specifically, because just to kind of read exactly, the data show that online deposits increased by more than 62% from 2019 to 2020. And then over the same time, deposits at brick and mortar branches grew by slightly more than 21%. So online deposits increased by another 42% from 2020 to 2021, while brick and mortar deposits grew around 10%. So obviously everything's going more online. That's kind of more, it seems like it's more of a general trend, honestly. And you see that all the time. But basically, it seems in total, these online deposits at US commercial banks are more than 5% of all deposits, period. And this is expected to increase, right? And so, since we know that deposit relationships generally lead to consumers to develop other types of banking relationships, a comprehensive analysis of competition needs to account for the ubiquity of the out of market banks with a strong national presence, right? And so, it's not so much breaking up the individual banks, I guess you should say, in terms of online portion and the actual banks. And so it's not like they're kind of viewed as different entities. It's more of, with online banking and, to say explicitly, online deposit gathering, as she puts it, it seems like it's more, if you're in, well, take me for example, whatever. If you live in Florida, now you're not necessarily going to be in that specific Florida banking market anymore, because you can bank now via online bank in Minnesota, right? And so you're not landlocked in terms of who you can bank with. And so you have these out of market banks coming in, or able to come in, or even just brought in by the consumers themselves, whether it be via presence or whatever, to really kind of negate the market, I'm sorry, the geographical kind of boundaries for the banking relationships in general. Um, at least that's what it kind of seems like. And again, I already kind of touched on this a little bit with the non-bank competitors. And so today, we're seeing mortgage companies not only compete but dominate the market for residential mortgage loans. Non-bank fintech firms have become viable competitors for nearly all types of loan products, but most prominently consumer loans, small business loans, and student loans. And so one challenge is that we don't have the same consistent set of data for non-bank entities that we do for banks, right? So these kind of like these mortgage companies and the other fintech firms and that sort of thing, they don't have the same regulatory requirements in terms of actual the reporting of their data to the Federal Reserve, like specifically. And so it's kind of seeing it's harder. I guess it's not as transparent in that respect because they're kind of filling a hole in the market that banks are apparently not doing well enough in. I guess community banks, because if the community banks were ultra competitive with these non-bank firms, whether that be via specialization or whatever, I'd assume that this wouldn't be a problem and we wouldn't be having this speech in the first place. Um, so yeah. So because of these kind of dynamics with newer competitors, newer markets, and the market's just kind of evolving with respect to banking in general, the needs for banking products and services are changing drastically for time or with time. That basically the argument is they need to modernize their competitive analysis, right? And so they talk about specifically with rural communities, and this is kind of where you have the more of the farming and agricultural loans come in. Basically, with these rural communities, especially in markets where the populations have declined, um, these institutions are having trouble basically keeping scale. And so basically, these out of market kind of digital banking relationships are also another competitor for these banks that are already struggling out in the rural areas. And so, according to that survey, I'm sorry, a different survey, the CSBS National Survey, 30% of respondents reported that depopulation was either important or very important to a rural bank's ability to attract and retain deposits. And so, those banks are struggling, it seems significantly relative to other community banks in different areas. So, it's just something to keep in mind. So talking about the actual changing of the we'll say framework or of their competitive analysis, right? And so the goal should be to apply a transparent, dynamic framework that allows the industry to evolve with market conditions and apply sensible regulatory oversight. And so where size isn't really a controlling factor, right? So it seems like it's kind of like not necessarily putting smaller community banks and say large commercial banks or that are national in scope on a level playing field. Wow, I cannot talk this morning. On a level playing field, because you can't really have them have the same regulations because as we talked about earlier and is explained in the speech too, is the cost of compliance with those regulations. So it seems like kind of changing, we'll say, kind of the weightings with respect to size, I guess, to where the size is kind of not really affected. I don't say affected. Where the size, I'm sorry, the where the regulations and such are proportional to the size of the entity, right? So whether that be through the amount of review process, what exactly they have to report, whatever, kind of changes. And so she gives three kind of proposals for this, right? So more systemically include credit unions in all competitive analysis because they are becoming a major competitor again. And so that's something to keep in mind. They have to factor in these deposits at digital banks, those out of market kind of digital banking relationships we talked about a minute ago. And the problem is apparently these aren't reportable at the branch level, I guess, because they're via the internet. And so there's not really a specific bank you're dealing with or a specific branch you're dealing with. I mean, and so it's harder to kind of gauge that. And a lot of these banks are national in scope in this respect from the digital aspect. And so they talk about basically, it seems like weighing the deposits across the I guess I don't want to say equally weighting, but kind of proportionally weighting the amount of digital deposits within each market, with each banking market or whatever it is of those 1,400 that we talked about earlier. Um, don't know how they would weigh that or what, but kind of just figuring out how to factor that in so that it kind of makes sense, whether that be via kind of a proportional to the population, to the amount of banks, whatever it happens to be, but factoring that in somehow. And then finally, consider non-bank financial firms in all competitive analyses, basically those mortgage companies and that sort of thing, right? And so this is where we get into the tool for Cassidy. So since 2006, the Federal Reserve Bank of St. Louis has supported competitive factors analysis through its development and maintenance of the Competitive Analysis and Structure Source Instrument for Depository Institutions, or Cassidy. Um, they just There's always so many acronyms when it comes to this sort of thing. That's one thing that I've noticed as I've done these videos is there's so many acronyms that it's just ridiculous. But anyways, the tool gives the public direct insights into currently defined banking markets in the United States and allows for the pro forma evaluation of the competitive effects of actual and even historical mergers. And so I guess I'll put a link to the tool itself as well in the description. But as always, I'll put the link to the speech too so you can read it yourself and blah, 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 sort of thing. But it's this last one down here, the 10th citation or whatever. And I also switch over. Well, normally I can just switch to it. All right, so we're going to stop sharing. Come over here, share. So normally it gives me an option to just switch tabs, but it didn't this time. So share here. This is kind of what it looks like when you click on that link. And so it seems like you can like find individual markets. And disclaimer, I haven't actually explored the tool too much yet. So this is all kind of unregarded territory. But yeah, it seems like you can go by market, select state. So I guess we'll just do Florida. And then Escambia County, get into Pensacola or whatever. Well, let's see what else we got in here. These are all the little towns. And Daytona Beach isn't in Escambia County. So I guess the sorting tool part isn't that great. Panama City Beach is not in that county either. Pensacola is. So we'll go there and then just, it's one or the other. Anyways, shows you how much I pay attention. So go to market. Do I have to click on something? Like I said, I haven't actually explored the tool. I would have assumed we'd have some sort of thing popping up already. I figured this would have been good enough to show stuff, but apparently not. There we maybe. Jesus. All right. How about this one? How do I get to see like actual data and stuff? Because I'm kind of save market to session here. Oh, I guess that's defining the area. And then this is where you get the other data, market share, where you put it into different banks and states. Again, I haven't exactly put in or gone through this sort of thing, so just kind of showing you there's a map, kind of exploring it together for a second. Yeah, there's Escambia County. I guess that's not very helpful. And then just history. So what does this tell us? Okay. Anyways, we're going to stop the share. Leave that one here. There's that Cassidy tool if you want to explore it further. Obviously, I'll probably do some more later just because I have no idea what I'm looking at. I guess mostly is in the structure and that index we were talking about, the HHI, to where it shows deposits. I guess it ranks the banks and shows kind of a percentage of market share, weighted and unweighted. So it'd be interesting to see exactly what they mean. Not really sure what the other tabs do. But anyways, something to explore if you're interested. But anyways, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.